So guys, welcome to Yusan, and you are watching that Investments for Beginners series. This is part 5, and in this video we will discussing about the initial public offering IPO and further public offering, it means FPO, their do's and don't. In the last part 3 we discuss about that the capital market equity share and debt, debenture or bonds, and primary market, secondary market. Now let's start the part 4 of this video series. Now, purchasing security in the primary market. Purchasing security in the primary market is two type. First is initial public offering IPO. Now, what is IPO? IPO is when a hetero unlisted company make either a fresh issue for share or some of its existing shareholder makes an offer to sell of part of their existing shareholding for the first time to the public, right? It's mean the name is suggest itself that initial public. It's mean the first time public can buy or sell. The paves the way for the listing and trading of such a shares. An IPO of fresh share is typically made by the company when it need money for growth expansion. To gather more money, the fresh company make an IPO and set some values and decide for IPOs. So why company offer this IPO for the public? Because either they need money for growth expansion or diversification or acquisition, or even to meet its increasing work capital requirement. Now, in an IPO involve an offer for sale. The process go to the selling shareholders. So this is the basics, fundamental things about the IPO, and there is also lots of things that this. Now come to the basics of FPO. What is FPO? FPO is further public offering. It's not a first time, it is a second time, maybe third time. When an already listed company make either a fresh issue of security to the public or the existing promoters make an offer for sale to the public. An FPO, whether a fresh security are issued, is typically made by the companies when it need money for growth expansion or diversification or acquisition, or even meet the increasing work capital requirement. An FPO is also preferred route over a right issue when the companies want to bring a new investors, both institutional as well as retail. We will talk about that who are the institutional investors and retail investors. So it may be pointed out that the FPO route is also being utilized extensively by the government for the PSUs for the purpose of disinvestments of a government holding. Now, another point about FPO is regarding price of shares offer in an IPO or an FPO. SEBI does not play any role in price in the support. SEBI is the authority, government authority, Stock Exchange Board of India. So he regulate all about investments, companies and their shares. But regarding price of a share offer for an IPO or FPO, SEBI doesn't play any role in price fixation. Now this issue company. So the issue company decide the price. In support of this, it is required to give full disclosure in the offer documents and also justify the issue price by parameters such as EPS, PE, multiple, and return on net worth, and comparison of those parameters with pre-group companies. There are two types of issues. In one, the company fix a specified price called fixed price issue, FPI, fixed price issue. In the other, the company stipulate a floor price or a price band with 20%, and for example, and invite bids from the market to them determine the final price. It is called book building issue, right? BBI. In the case of FPO, the issue price is normally at a discount to the current market price. Understand? You got it? So first is fixed price issue, then book building issue, then we call for FPO current market price, right, at a discount on the current market price. Some companies and specifically the PSU offer a discount on the retail investors in both IPOs and FPOs up to maximum 10%. Right, so this is the basics and general thing about IPOs and FPOs. And now let's move on to the do's and don't when we see the FPOs and IPOs, and what should we do and what we should not, what we don't. Right, so first we will talk about the do's. What are the do's? Now read the prospectus, abridged prospectus, carefully with special attention to the risk factor, background of promoters, company history, outstanding litigation and detailed the financial statement, objects of the issue, basis of issue price, instruction of a market and application. So those things need to be pay the special attention when we read the prospectus. All will be written in the prospectus. Just go on their websites and read that when they are offering this IPO FPO, just download the prospectus and read it. Okay, use the ASBA process for applying this. Now what is ASBA process? We will discuss later on. Now under this, the investor authorize his bank to block in his bank account an amount equivalent to the application's money. You not understand, right? So use the ASBA process. What is ASBA process of applying this? The investor authorize his bank to block in his bank account an amount equivalent to the application money. The money remain in the bank upon finalization of the basis of allotment. Only the amount equivalent to the allotment amount is debit to the bank account. So set the price, right? So ASBA process is that process that fix that amount, what amount you want to debit, right? So equivalent to the allotment amount is debit to the bank account, and the rest is free up. Now in case of non-receipt within due period, the credit to demat account or refund of application money, lodge a complaint with complaint officer of the issue and with post issue lead manager, right? So that is all about that's do's and not the end, but yes, you should be very careful. Now come to the don'ts part, what not to do. Now don'ts for investment in IPOs or FPOs. First is don't be influenced by the implicit or explicit promise made by the issue or anyone else. So this rule is very important when we're talking about the investments in any case, whether it is stock, bonds, equity funds, debt funds, anywhere, mutual funds. Don't influenced by any implicit, explicit promise made by any one of them. Now don't invest based only on the prevailing bull run of the market index or of a script of other companies in the same industry or script of the issue company or group companies. Company or group companies. Now don't expect the price of the shares of the issue company to necessarily go up upon listing forever. So this is very important. So don't expect the price of the shares of the issue company to necessarily go up upon listing or forever. So this is all about the do's and don'ts. Now we talk about that purchase security in the primary market in these topics. Now we have also the topics where we will go, that is purchasing security in the secondary market and do's and don'ts of this very market. So for now, this video we will talk about those things in the next video, in the next part. So I hope guys you enjoy this lesson, and so we revise. If we revise it, then we learn about initial public offering, FPOs, further public offering, then what is fixed price issue, then market price issue, book building issues, right? Discounts, then do's and don'ts we discuss in this very lecture. Now we will discuss in the next video about the purchasing security in the stock markets and do's and don'ts of that. So thank you guys and keep watching, and if you have any query related to this, so ask on the comment section, and we will try to reply your comments. Thank you.